JPMorgan just made a silver move that rewired the entire market overnight. There was no press conference, no emergency headline, no warning ticker flashing across your screen. But if you were watching the flow instead of the noise, you saw it. A shift so quiet that most people missed it, and so large that it instantly changed the balance of power in silver. Silver didn't move because of speculation. It didn't move because of retail hype. It moved because one of the most powerful institutions in global finance changed its posture behind closed doors. Here's the number you need to focus on right now. Hundreds of millions of ounces, not contracts, not exposure, physical silver. That's the scale of what we're talking about. If you're watching this and thinking banks don't operate in physical commodities anymore, here's the mistake most people make. They assume the biggest moves always happen on screens. They don't. They happen in vaults, in delivery reports, and in positioning shifts that only show up after the damage is done. This is why this matters. When a player like JPMorgan changes direction in silver, it doesn't chase price. It creates it. The market reacts later. Much later. And here's the part that should immediately get your attention. This move didn't happen during a calm period. It happened when silver was already under pressure from tightening supply, rising industrial demand, and increasing leverage across paper markets. If you're watching this right now and wondering why price action suddenly feels unstable, why volatility keeps showing up without warning, this is where you need to stop looking at charts and start looking at behavior. Because what JPMorgan just did wasn't defensive. It wasn't accidental, and it wasn't small. Stay with me until the end, because I'm going to show you why this move changes how silver trades from here forward and why most people won't understand it until they're forced to react. But this is only the surface. To understand why this move landed with so much force, you first need to understand why the timing couldn't have been worse. And that's where the real story begins. Why this matters now. This matters now because the silver market was already stretched to its limit before JPMorgan made its move. Silver wasn't trading in a vacuum. Inventories were thinning. Industrial demand was accelerating. Leverage was building quietly across futures, ETFs, and structured products. The system looked stable on the surface, but underneath it was running on assumptions that no longer held. Here's the number you need to anchor on. Global silver demand has exceeded supply for multiple consecutive years. That gap didn't trigger headlines because inventories absorbed it. But inventories are not infinite. They are buffers. And buffers, once depleted, don't refill on command. If you're watching this thinking, if it was that tight, prices would already reflect it, here's the mistake most people make. Markets price comfort first and reality later. Stress accumulates silently until behavior changes. Then price catches up fast. Now here's where it gets interesting. JPMorgan didn't adjust its silver posture during a surplus. It moved when supply was already constrained and demand was structurally rising. That timing is not coincidence. That timing is signal. This is why this matters. When a dominant institution shifts positioning during fragility, it amplifies existing pressure. It doesn't create the imbalance. It exploits it. And this changes everything for anyone still treating silver like a liquid, easily sourced asset. If you're watching this closely, understand what that means. When demand rises and supply tightens at the same time, the market doesn't negotiate. It reprices. But timing alone doesn't explain how one bank can alter the behavior of an entire market. To understand that, you need to understand the mechanism JPMorgan used to turn positioning into leverage. And that's the part nobody's talking about. The mechanism. To understand how JPMorgan pulled this off, you need to understand one simple mechanism: control through optionality. Think of the silver market like a crowded theater with only a few exits. Paper contracts represent tickets. Physical silver represents the doors. As long as nobody rushes the exits, the system looks calm. But the moment a major player controls the doors, everyone else's options shrink instantly. JPMorgan focused on the doors. Here's the number that reframes everything. The vast majority of silver trading volume is paper, futures, options, swaps, promises to deliver later. But only a small fraction of that volume is backed by metal that can actually move. Physical silver is the constraint, always has been. Now here's where it gets interesting. JPMorgan didn't just trade exposure, it accumulated control over deliverable supply. That gives it something paper traders don't have: optionality, the ability to deliver, withhold, or time releases when the system is stressed. If you're watching this and thinking that sounds abstract, here's the practical impact. When delivery pressure rises, the party with metal dictates terms, spreads widen, lease rates spike, panic shows up in places charts don't capture. Here's the mistake most people make. They assume futures markets determine price. In reality, delivery determines credibility, and credibility determines price when confidence cracks. Let me connect the dots. By controlling physical silver while paper exposure remained elevated, JPMorgan positioned itself upstream of volatility. It didn't need to predict price moves. It needed to control flow, and this changes everything about how silver reacts during stress. But control alone doesn't explain why this move happened now instead of years ago. For that, you need to look at the primary force that pushed JPMorgan off the sidelines. And that force was building long before this move ever showed up on anyone's radar. The primary cause. The primary cause behind JPMorgan's move is risk asymmetry. For years, the bank operated on both sides of the silver market. Paper exposure on one side, physical accumulation on the other. That structure works as long as volatility stays contained and delivery pressure remains low. That balance just broke. Here's the number that matters. Physical silver inventories available for delivery have fallen dramatically relative to outstanding paper claims. The ratio between promises and metal widened to a point where control mattered more than exposure. If you're watching this and assuming JPMorgan moved because it saw higher prices coming, that's the wrong framing. This wasn't a directional bet. It was a risk transfer. Now here's where it gets interesting. When paper exposure grows faster than physical availability, someone eventually bears delivery risk. JPMorgan moved to make sure it wouldn't be them. This is why the shift happened quietly. No need to advertise. No need to chase price. Just reposition so that if stress erupts, the pressure flows outward, not inward. Here's the mistake most people make. They think banks react late. In reality, banks react when asymmetry flips. When risk becomes unbounded on one side and capped on the other, they move decisively. And this changes everything for market participants who are still relying on smooth settlement and stable spreads. But risk asymmetry alone doesn't explain why this move had such immediate systemic impact. For that, you need to understand the secondary force that turned repositioning into a shock, and that's where timing comes back into focus. The secondary cause. The secondary cause is timing, and timing turned positioning into shock. JPMorgan didn't move in a calm market. It moved when leverage was already stacked high across silver futures, ETFs, and derivatives. The structure looked liquid, but liquidity was conditional. It depended on confidence in delivery. Here's the number you need to lock in. Paper silver claims now outweigh readily deliverable metal by orders of magnitude. That imbalance doesn't matter until someone large changes behavior. Then it matters all at once. Now here's where it gets interesting. JPMorgan's shift didn't force anyone to panic. It forced them to reassess. Counterparties suddenly had to ask a different question. Not what is silver worth, but who can actually deliver. If you're watching this and wondering why volatility spiked without a headline, this is why. Repricing doesn't always start with fear. It starts with recalculation. Here's the mistake most people make. They assume leverage only matters when prices fall. In reality, leverage matters most when assumptions fail. When delivery is questioned, leverage becomes a liability instantly. Let me connect the dots. JPMorgan positioned itself so that if stress rose, others would scramble for metal while it already held optionality. That scramble is what injects volatility into the system, and this changes everything about short-term stability. But this kind of structural stress isn't new. Markets have been here before under different names and different conditions. To understand where this leads, you have to look backward before you look forward. And that's where history enters the frame. The historical rhyme. This is not the first time a dominant financial institution quietly shifted control before the rest of the market understood what was happening. History never repeats cleanly, but it leaves patterns, and when you line those patterns up, JP Morgan's move fits a familiar shape. Control consolidates, optionality tightens, volatility follows. Here's the number that matters. In previous silver stress events, price didn't break first, settlement did, spreads widened, lease rates jumped, delivery schedules slipped, price reacted last. Now here's where it gets interesting. In every major silver dislocation over the past decades, the players who controlled physical supply emerged stronger, while those who relied on paper exposure were forced to react under pressure. If you're watching this thinking history doesn't apply anymore because markets are more sophisticated, here's the mistake most people make. Complexity doesn't remove constraints. It hides them until they assert themselves. This is why JP Morgan's move rhymes with past inflection points. Not because the numbers are identical, but because the behavior is. Control first, volatility second, repricing last. And this changes everything about how the current setup should be interpreted. But history alone doesn't tell you whether this move signals the beginning of a longer shift or just a violent adjustment. For that, you have to weigh both sides of the argument honestly. Now here's where it gets serious. There is a bearish case that sounds reasonable, and a bullish case that refuses to break. The tension between them determines what comes next. The bull versus bear case. The bearish case deserves respect because it sounds disciplined. From that angle, JP Morgan's move is defensive, a balance sheet adjustment, a risk hedge during elevated volatility. In this scenario, silver remains range-bound, physical stress eases, delivery normalizes. The system absorbs the shock and moves forward. Here's the number bears point to. Global mine production still sits above 800 million ounces annually. On paper, that looks sufficient to meet demand. From this view, JP Morgan didn't signal scarcity. It signaled caution. That argument is coherent and incomplete. Here's the mistake most people make. They confuse production with availability. Those are not the same thing. Now let me connect the dots. Silver is not oil. It isn't stored in massive strategic reserves. It's consumed. Once it enters industrial use, much of it never comes back. Recycling is limited. Substitution is weak. Flow matters more than totals. Here's the number that shifts the weight. Industrial demand now absorbs more than half of annual silver supply, and that share keeps rising. Solar alone consumes tens of millions of ounces per year. That demand doesn't pause because a bank adjusts positioning. This is why the bullish case holds its ground. When a consumed input faces constrained flow and rising demand, pressure builds even when prices pull back. And once pressure reaches a threshold, repricing doesn't ask for permission. But risk still exists. Policy changes happen. Demand can soften in downturns. Substitution accelerates at extreme prices. These forces are real. Here's what separates a reset from a reversal. In reversals, flow improves and stress fades. In resets, stress persists, even when price cools. Which one this becomes depends on confirmation. And that brings us to the only thing that matters now, the signals that reveal which path the market is choosing. And this is the part nobody's talking about. Confirmation, posture, and the decision point. Here's how you confirm whether JP Morgan's move was a temporary adjustment or a structural shift. First, watch delivery behavior. When stress is real, physical premiums stay firm even during pullbacks. Metal moves before price does. If availability tightens quietly, the system is under pressure. Second, watch inventory trends. If deliverable inventories continue to drift lower while paper exposure remains high, pressure compounds. If inventories rebuild decisively, the system adapts. That distinction matters more than daily price action. Third, watch counterparty behavior. When participants stop trusting smooth settlement and start locking in supply early, confidence is already breaking. If you're watching this and asking what I'm doing, understand this clearly. This is posture, not advice. I'm not reacting to headlines. I'm watching flow, availability, and behavior. Those signals move first. Now here's where it gets interesting. There are three types of people watching this unfold. The first dismisses it. You assume the system holds and nothing changes. The second hesitates. You see the risk but wait for certainty that only arrives after repricing. The third recognizes inflection points before they're obvious. Which one you are determines whether you react late or prepare early. Let me restate the thesis clearly. JPMorgan didn't just adjust silver exposure. It repositioned around physical control at a moment when leverage, demand, and constrained supply collided. That doesn't guarantee outcomes. It changes probabilities. This moment will be remembered not because of a headline, but because it marked a shift from paper confidence to physical reality. If this helped you see beneath the surface, share it with one person who still thinks silver is just another trade. Drop a comment so I know you're tracking the signals. Subscribe if you want analysis that focuses on structure, not noise. Stay disciplined, stay observant. This market rewards preparation, not reaction. And one more thing before you go. The real signal won't be a breakout or a crash. It will be silence. When stress builds without relief, when delivery tightens without headlines, when behavior shifts quietly, that's when you'll know this move wasn't temporary. Watch that closely. It decides what comes next.